And Megan, let's go ahead and get started.
Hello and welcome to the Scottsdale Founders Forum. My name is Miguel Roman. I am the Administrative Manager at AXIOM Founders Family Office. It is my pleasure to introduce to you Armando Roman, who will be your host for today's event. Armando is the CEO of AXIOM Founders Family Office, the multifamily office and wealth management firm for founders. Armando built and exited two businesses, including a CPA firm providing tax and accounting services to businesses and families. He operated that CPA firm for 14 years and then sold it. Armando founded the Scottsdale Founders Forum and the Founders Guidepost podcast to help founders successfully exit their business. A sought-after speaker and presenter, Armando was invited by the FBI to train 400 special agents, all of whom were CPAs, to train them about their personal financial planning. He was appointed by two bishops of the Roman Catholic Diocese of Phoenix to provide oversight for prudent investment management of the diocese investment portfolio and provided the same oversight for one of Arizona's largest nonprofit organizations, the Arizona Community Foundation. Armando led the CPA profession in Arizona and nationally, serving as chairman of the board of the Arizona Society of CPAs and serving on the National CPA Financial Literacy Commission and governing body of the American Institute of CPAs. Armando and his team help founders and their families protect, preserve, and grow their overall net worth. Please welcome Armando Roman.
Thank you, Miguel, for the introduction. And thank you for joining us for the Scottsdale Founders Forum. We've been having this event now for 4 years. The event is all about exit, and it's for that business owner who is going through the exit for the first time and thinking about that exit and how to go about it. A little housekeeping first. We are recording this Zoom, and so afterwards you will receive a link to the recording of this event today. And the guest, I'll introduce him in just a moment here. But the conversation today is all about you, that founder. And a quick spoiler alert, everybody dies. It's just how it works. But you know, that great business that you've built, that does not have to die. And the way you can keep that alive and or transition that to the next person, the next owner, is to plan ahead and be thoughtful, methodical, get the right people around you to help you make that transition of that business. And I'll just mention, speaking of mortality quickly, that average age for a man mortality is age 74. It's been dropping to lower numbers, and for women, it's about age 78. But before you get nervous when you think about your own age, also think about this: you are not average. Nobody's average, but we need those measuring sticks so that we can come up with some ways to get some planning together for ourselves, our businesses, and our family. So again, today is all about you, all about the transition of your business. Here's what you are going to know. You will know when to start planning. You will know what expertise should be on your team, basic anatomy of a sale, and what pitfalls to avoid. Here's what you're going to have. You're going to have an opportunity to hear experts who buy and sell businesses for a living. And the Q&A afterwards, we've got 30 minutes set up at the end of this at 4:30 so that it's just for Q&A for your questions. And here's what you're going to feel. You're going to feel better, that you can now be better prepared to go through that once in a lifetime sale. You will feel more confident knowing the steps that you should be taking now. AXIOM Founders Family Office is our wealth advisory firm and multifamily office. We put this event together because we had a client go through an exit years ago, and they were going through a pretty sizable exit. And they called me, the client called me the second week of November. They're trying to get it closed by December 31. And knowing this couple that owned this business, I knew they were very generous people. So when I got a call from the client and we got an update on where that sale process was, I asked her, when are you going to close? She said December 31. I said, great. I called her tax CPA to say, hey, our joint client who's going through this exit, they're very generous people. Have you had a chance to talk with them about charitable giving and how that could be so impactful to reduce that tax bill with this once in a lifetime transaction? And his response was, no, Armando, they're too busy right now. I'm going to wait till it closes and then we'll have that conversation. So this sale closed on December 30th. The next day was New Year's Eve, December 31st. They had a very sizable exit from their business without the appropriate tax planning, I felt. So the decision that we came to was, we're never going to let that happen again to one of our clients or anybody else who will listen. And that was how this event came about, the genesis of this event. We're a multifamily office, sometimes called a family CFO, but don't worry, no one's going to try to sell you any life insurance or products, but we will reach out to you afterwards to see if a meeting might make sense, to see if we might be a good fit for each other. And I think that sounds fair. People often think that we're an ordinary wealth management firm when in fact we're not. And I say that because we're focused on the founder and the founder's family that happens to own a business worth millions. And part of why I say that is when you, the viewer, the listener here, when you think about your own personal balance sheet and you look at the largest asset, the largest wealth, your family wealth that you have, it's probably in that business. And I can say that because that's normal. That's what happens with people who build great companies over time. So we think that it's our responsibility and our obligation to understand that value in the business and help you preserve it, protect it, and grow it. So we use a comprehensive process to help our clients make smart decisions about their money, to help them plan, to help them mitigate taxes, take care of errors, and make sure assets are not unjustly taken through litigation, help magnify charitable gifts, and to help them navigate this once-in-a-lifetime exit. We've got a team of professionals that we work with to help us do that. And two of those people are here. You'll understand as we talk with them more about their expertise and why it can be extremely, extremely relevant for you as you think about navigating your own exit of your business. So here's how this is going to work. I'm going to ask questions of both John and Phil, and first I'll introduce them. I'll begin by introducing John, John Farr, who you see with the beard there. Hi, John. How are you?
Hey, hey.
So let me introduce you, John. John Farr has spent his career serving companies in the consumer, health and wellness, manufacturing, industrial technology, and aerospace industries. Before Columbia West, he worked with PNC Equity Management, a $1 billion private equity group engaged in growth equity, leveraged buyout, and mezzanine loan investing. He began his investment banking career at Deutsche Bank, where he worked as an analyst and associate with the private placement team. Mr. Farr earned a BA in economics and business administration from Vanderbilt University and an MBA from with concentrations in finance, accounting, and strategy from the Kellogg School of Management at Northwestern. John Farr, Managing Director of Columbia West Capital. Welcome, John.
How are you?
Good, good. So now let me introduce Phil Guttilla. Phil, hi there.
Hi, Armando.
So let me introduce you. Phil is a deal lawyer who gets transactions closed. Whether navigating a complex business acquisition with a compressed timeline or structuring a mission-critical financing, he delivers practical solutions and creative problem solving that move deals forward. As both a certified public accountant and a chartered financial analyst, Phil brings a rare multidisciplinary perspective that addresses the legal, financial, and tax implications of every transaction. Selling your business is likely the most significant financial event of your lifetime. Phil understands this deeply. Business owners seek him out not just for his 30 years of experience, but for his dedication to achieving the best possible outcome for you. He and his team negotiate relentlessly on your behalf, drawing on his unique tax and accounting background to guide you through every stage of the deal process and position you for maximum value. Phil delivers what he demands from himself and from his team. He demands thought leadership, creative solutions, and superior responsiveness. He builds deep, lasting relationships with his clients, many spanning decades, because he operates as a trusted advisor who helps minimize tax exposure, maximize enterprise value, and maintain strategic focus on what matters most. So I'll introduce to you Phil Guttilla, Office Managing Partner in Phoenix of the Polsinelli Law Firm.
Thanks for
Welcome again,
Armando.
Phil.
Thank you.
What we'll do now is I'm going to ask each of you questions, and I might ask you some clarifying questions so that you can help our viewers understand why they need your expertise and maybe you on their team as they think about exit. And so, Phil, I'll begin with you. When you think about the basic anatomy of a business sale as the attorney, what comes to mind for you? What is that basic anatomy of a sale?
Well, I think most of us on this call have probably sold a house before, and you know what you do, you sell a house, you get all your junk out of it, you get the furniture arranged, you make it look good, you cut the lawn, you might get your landscaping done. It's similar with the business. When you're looking to go to market, you want to make sure you're not running excess personal expenses through the business, or if you are, you're adding those back. John will tell us about normalizing earnings later on. And a big part of that is getting your legal house in order. If you're selling a business and you're, a patent or a trademark or trade secret or your workforce are kind of the keys, secret sauce to your business, that's what makes it work and makes you profitable. You're going to want to make sure that before you go to market and put your company up for sale, that you have solid contracts, that those have been updated, that they're compliant with the applicable law. Employment laws change, non-compete laws change, intellectual property laws change. All that stuff needs to be reviewed from time to time by good legal counsel. You need to have very solid, if your intellectual property portfolio is something that adds value, that should be maintained. And, it's important that if you've, say, developed some software and you had a contractor do it, that you have certain provisions in that contract that make sure that your company owns the software. The default rule with a contractor is they own what they create for you, unless you include an assignment in your contract where you get to keep that work product and the copyright and all the IP rights. So I would say getting and making sure that you're ready to flip a switch and go to market, and preparing ahead of time is probably the most important thing.
There's a lot in what you just said.
Yeah.
Excellent. And then, John, let me ask you, what does an investment banker do?
We essentially run the process for selling that business that Phil was alluding to as your agent. So that means preparing the materials, positioning your story, running a competitive process, ideally, if you'll let us, with a number of potential bidders that creates leverage for you. So we're acting as your advocate. I'll call it your project manager in running the process. It's popular that we're identifying bidders. That's what a lot of people think of, but I'll say that we're also negotiating with those bidders. We're coordinating the team, including the accountants, the tax advisors, and M&A attorneys like Phil. So in short, we're providing the competition, but we're also providing the order and strategy to what might otherwise be a one-off negotiation.
Okay, well, there's a lot of what you just said as well. We'll get into more deeply what you just described. You mentioned a process of going through that actual sale of the business. I know as I talk with business owners, they're often very, very clear that they want to be anonymous. How do you help protect their anonymity as you go through that process with them?
How do I do that? Or is that for me or for Phil?
Yeah, well, for you, John. Sorry, yes.
Well, from our perspective, we do provide a confidentiality agreement up front. We call it a non-disclosure agreement. We'll write a one-page teaser, and that is a no-names teaser. So we send that out, generally describing the business, but it's attached to an NDA, and that has a lot of the fundamental protections that an organization is going to want to see. We'll commonly have that reviewed by the attorney involved. So we'll create that letter. We'll send it over to Phil and say, hey, does this look okay? He says yes, or maybe add this, add that. But long story short, we send that out to all these potential bidders, and they do not receive that confidential information memorandum, that longer document that does name names. They would not receive that until they've signed the NDA. So we make sure that they're protected. And so the NDA is going to have obviously things around disclosure, but also discussions around non-solicit of employees, treatment of IP, other protections like that. And frankly, it tends to be pretty heavy-handed on our clients' behalf. It's very common for investors to push back because our document is so heavy-handed, but that's how we like to start it anyway. So that's a great way of protecting them.
Right. And just to clarify, NDA, of course, is non-disclosure agreement,
Exactly.
right? Okay.
or also called confidentiality agreement.
Yeah.
I'd like to include a non-solicitation of employees covenant. That means that for a period of time, the bidder who becomes aware this company's on the market can't try to hire your employees. If you decide you're not going to go with them, you don't want them going and picking off your employees and, saying, hey, your company might be for sale or so on. So
Yeah.
that can add some protection. And I usually like to get 2 or 3 years if possible
Wow.
protection for my clients.
Good. Excellent. Thank you. And a question that we hear is often, what's the biggest question or concern that we help that first time seller address? And for that question, the question really is, are you ready? Is that business owner ready? They spent years and many weekends, years of their life building that company. And so what we hear from them often is, are they ready? And the way we help them understand if they're ready or not is we have a conversation, we guide a conversation with them. So John, you mentioned you have a process you go through. We have a process as well where we meet with the couple that owns that business, or if there are two partners, meet with each couple and have a conversation with the couple about their values, their goals, the people who matter in their lives. What are all the assets they have? Because that's what's going to then generate the cash flow, the monthly cash flow for them beyond the sale. And we have a conversation about their interests, because when someone has spent so many years of their life building a company and they think about it 24/7, literally, it's hard to just turn that switch off and walk away. So
Right.
we want to make sure that we can help them as much as possible to answer that question. Am I ready to sell my business or not? Are they mentally ready, emotionally ready? Are they financially ready? So that's the question that we get, that we help them address quite often. Another John, another question for you. When you are hired, how do you help the founder optimize their enterprise value?
Okay, the most popular and the most easily understood is driving up the valuation multiple. Obviously, they want to get paid more on a relative basis for that cash flow. But it's not really just about that. It's about structure. It's about timing. It's about positioning. We try to help founders position their business in a manner that highlights things like growth drivers, scalability, even defensibility, right? So the business made $10 million last year. How do we know that that will continue? How do we know that it's going to grow? We believe it's going to grow. So positioning is one of those underappreciated things that we do. We're trying to essentially find the most exciting attributes that a company has, and ideally find the investors who most need those attributes. So the goal is to find that buyer who views our client as that missing puzzle piece that strengthens their standing in the market, or that helps them grow through revenue synergies or what have you. So obviously we're running an auction, ideally, which creates competitive tension, but it also has to do with getting those readers excited about what they're seeing. So we see so many operators who are great at running their businesses, but they're not necessarily good at talking to people who aren't insiders, who aren't industry veterans. And so a lot of what we're doing is just teasing out a lot of those exciting things about the business to make sure that they get seen and they're appreciated in the value.
Okay. So
The
you
other
really
thing,
have to,
sorry, go ahead. What?
you really have to understand that business, and you really have to understand what the buyer's perspective might be to make that fit and really make that valuable to the buyer.
Exactly.
So
Exactly.
Excellent.
John will also go through and add back expenses that the buyer won't be saddled with. If someone's running their personal boat, or sports car through the company, for the tax reasons, that gets added back, because that's going to be, for every dollar you can add to your earnings or your cash flow. If John finds a buyer that's going to pay an 8 or 10 multiple, that's worth $8 or $10. So you add back, $1 million, you could have an $8 million higher price if you're selling at an 8 multiple.
Right.
And companies are valued based on multiples of cash flow. We call it EBITDA, which is earnings before depreciation, amortization, interest, and taxes.
Mm-hmm.
And it's really a proxy for cash flow. So if I were going to buy your company, I want to know how much money I can take out of it every year and put in my pocket. That's what EBITDA measures and tells me. And then if, depending on as EBITDA grows, the the multiple goes up. I don't know, John, if you want to talk about how that works.
Yeah, good. And I do want to talk about the multiple in just one second here, but one quick housekeeping that I want to add for the listener who's watching this right now as we have this conversation. Up in the upper right-hand corner of your screen, you might want to click on Gallery View so you can see all three of us at the same time. I think the default is Speaker View, so Gallery View might be a good way to see, because what I expect is what we're seeing right now is that John and Phil, myself, will have a dialogue amongst each other for the benefit of the viewer. So John and Phil, you both have mentioned the multiple, and I do want, and then you talked about also the sale value. John, when you talk about multiple, what you're talking about is the cash flow annually that's produced from that business, or the profit, which is a term that most of us would understand before we hear the term multiple, but it's somehow the net result of that business working all year times number 2 times number 3 times number 4. But the 2, 3, 4 is the multiple you're referring to, correct?
Correct. It's the industry shorthand to say that cash flow, EBITDA, adjusted EBITDA, as Phil pointed out, times the multiple equals the business enterprise value. It is shorthand, I'll say, just like in real estate, right? It's price per square foot times square footage. But as you know, there are more things that go into that. But simply put, we're trying to get both sides of those numbers up as it relates to cash flow, as Phil pointed out. Finding add backs are fantastic for us. We do that a lot, where a business making $4 million according to GAAP may actually be closer to 5.5 when you add back things like excessive compensation, son's tickets, the company car is a Ferrari, son's on the payroll and the son really doesn't show up to work, things of that nature. That business owners do and are encouraged to do from their tax professional. They're tough as it relates to marketing the business. So as Phil pointed out, you want to start tracking those types of things, making sure that we're able to bring those up and highlight them. And there are some ways we can get creative with that back. So that's the cash flow part of this. The multiple, on the other hand, is what multiple they'll attribute to that cash flow. The product of the two equals your enterprise value. But on the multiple side, we're effectively trying to find ways to argue why the business ought to merit a better multiple. Maybe there's some real estate associated with the business. Maybe you have intellectual property that comes along with the business. Maybe you're in a faster growing region. So something like municipal services that might be a 2% company grower in Idaho or Kansas might ought to get a better multiple here in Arizona, where you have so much population growth. We certainly argue that one a lot. So there are a number of reasons why we can try to get that multiple up. So enterprise value, from our perspective, is us coming up with all the reasons why they should be excited to pay more, and making sure that we're articulating that to the bidder who understands it best and wants it most as well.
Fantastic.
So
Thank
the
you.
human element, I'll call it, to that.
And Phil, you mentioned about the taxes and normalizing that, as John just talked about. But Phil, you brought up an extremely good point. When it's tax time, when I used to have my tax practice years ago, the number one question people would come in with is, or the number one complaint or comment is, I'm paying too much taxes. Help me lower my tax bill. So sometimes people get extremely aggressive with what they take through as company expenses. And that's great for that year's taxes. But you made a point that the viewer needs to really understand, if they're going to be going into a sale in the next couple of years or so, maybe they don't really want to do that. I'm not sure if they do or don't, but your point was the buyer is looking at cash flow and a multiple of that for the sale value. And you said that if John can get you another $1 million in cash flow times a multiple of say 8, that's another $8 million of sale value, which could clearly outweigh the tax benefit this year of flushing some of those things through. That was your point, correct?
Correct. And you don't have to completely, clean up, what you're running through your tax return. You just need to have John and his team normalize it when you go out to bidders and show them, if you buy the company, here's what your financials will look like. The tax returns are what they are. And that's my main point. It's not to, suddenly move everything off the balance sheet and start paying more in taxes. There's, a lot of, with bonus depreciation back, a lot of our clients are buying, lots of equipment and stuff that takes up a lot of cash, reduces their taxes, but that stuff needs to be looked at. And the other thing that is important, what John and his team will do is they'll prepare pro forma financials and show growth. The accountants, and Armando, you know this because you were an accountant, they kind of look in the rearview mirror. They're looking at the past, and that isn't exciting if you have a growing company. You need to not only look at the past, but show where it's going, show what the EBITDA could be in a year or two or three based on the growth that's, assuming you have a growing business that's happening. So that's a key kind of marketing, feature that a good banker like John will implement and will go to market with.
Great. Thank you, Phil. And Phil, a question for you. Besides sales price, what does the seller need to consider?
There's about a million things. Most business owners are super protective of their employees, the people that help them build the company to where it is, before they sell. So, the number one point I hear is they want to make sure that whatever buyer they pick, they're going to treat the team like they would, like family, and make sure that, the employee base is taken care of, they're incentivized. And incentives are aligned because a happy workforce will help grow the business and keep the train going and the projected growth going. So that would be number one. Number two would be, you already mentioned this. It's a Covey principle. You start with the end in mind. It's one of the 7 habits.
Yeah.
You get to closing. I saw companies, 100 million, 200 million. All this money hits a bank account. What are you going to do with it? Where's it going to be? Most of the time, you're going to, when I get in early, I'll take my clients to our wealth planning group and we'll do asset protection trusts. We'll do estate tax and gift tax protected trusts, so that when that event happens, a good chunk, if not all of the proceeds end up in these dynasty trusts where you can have a family office and have this generational wealth in a vehicle that can't be picked away at by ex-spouses or creditors or whoever. That's stepping way back. Ideally, you want to do that planning a year or two before you go to market, but it can be done in a month, a couple months. You're more compressed in your time.
Yeah. Thank you for that. And a question that we get really dovetails with what you just said, Phil. When the founder's ready to transition out of their business, what steps do they need to take with us? And it really centers that overall planning. So as an example, Phil, we just brought a client over to you who had some planning done, but had some gaps in their planning. So we're looking at the overall financial planning, tax reducing strategies, legacy planning, gifting as well. And when legal structures need to be created for that, then we'll make sure to bring in the attorney, as you mentioned, your team of attorneys who create, say, the charitable remainder trust or the irrevocable trust or the other vehicles that can be extremely impactful when they're having this enormous tax hit. And it's not just the taxes, but it's also, as you said, protecting that wealth from potential lawsuits, from potential divorces, from things that could certainly take away from that family net worth. So the planning that we're doing is all about that. We often begin with creating a personal balance sheet. And on that personal balance sheet, what the clients see with that is they see all of the pieces of their net worth. And then we can have a conversation about how do we protect those? How do we make sure that they stay intact? And that's with titling, that's with trusts, that's with business entities, it's with insurance policies. It's a variety of means that we use to make sure that we can help protect and preserve that overall family net worth. And that's all part of the planning that we do to help protect, preserve, and grow those assets going forward as they navigate beyond the sale of this business that they've had and nurtured for so many years. Question now again for you, Phil. There's an expression that the devil is in the details of in the sales contract. What should the seller be cautious of in that contract?
Well, first thing you need to do is make sure you hire someone that knows what they're doing, because M&A is an industry in and of itself. and you don't want to hire a divorce lawyer to handle your M&A deal or litigation, someone who's in court. You want to handle it. You want to hire a deal lawyer that's, all they do and they know what the market is. So there's market standards for M&A deals of all sizes. And if you have a buyer who's off market, that, they can be brought back because we can argue and if John's gone to them in a process and we have multiple bidders, we'll just tell the lead bidder who's being unreasonable or not, being fair, that we're just going to go to the backup bidder. I like to include, when we get to the letter of intent stage, I'll include a provision that says, if you retrade and drop the price you're offering, your exclusivity ends, and that frees us up to go to the second bidder and see if they'll match the price and if they want to bite at it. That's the kind of stuff that, if you're not doing deals all the time and you haven't seen that, understand how that works, you might not have a lawyer who knows how to handle that.
Right. I'm glad you brought that up. I spoke with a business owner a while back who mentioned he received an LOI from a prospective buyer, a letter of intent, letter of interest, whatever LOI stands for.
Yeah.
But he received this LOI, and the prospective seller thought that there was a standard template, so to speak, for an LOI, and didn't really see the need to go to their attorney, to go to you, Phil, for example, to have the attorney look at it before they signed it. And I'd like you to talk about that, Phil, if you could, because I've heard talk before that the terms and conditions in an LOI often end up in the actual sales, purchase sales agreement, and that the terms and conditions in the LOI can sometimes make somewhat of maybe a binding contract almost. Can you speak to that?
Yeah. So before you sign a letter of intent with your selected buyer, the seller, the business owner, has the maximum amount of leverage because the buyer doesn't have a deal. They don't have you locked up as a seller into exclusivity, meaning you have to negotiate with that buyer and you can't talk to anyone else once you sign the letter of intent. So you have the maximum amount of leverage before you enter into that document. The reason is when you sign up for exclusivity, if you were to breach that. So let's say you agree to sell to someone, you sign a letter of intent, and then you change your mind and you go negotiate with others and have violated the clause that says you're going to exclusively deal with that buyer, they can then sue for basically their fees and costs and damages. They can't force you to sell to them, but they can recover expenses, and those expenses could be hundreds of thousands of dollars because a buyer will invest in a quality of earnings. They'll do legal diligence. They'll do financial diligence. They'll invest a lot of money into making sure the company is what we tell them it is. Because when you're on the other side of a deal, it's a black box. You've got to turn over every rock and make sure that that company is really, has the cash flow, revenue, et cetera, that you've been told as a buyer. When you're in the sell side, before you sign it, we can negotiate in like a walkaway deal, meaning once a deal closes, there is no way, except for fraud, there's no way for the buyer to come back and make claims to recover some of the purchase price. That's called an insured deal. We have rep and warranty insurance as a fairly new product in the market, and we can often get buyers to pay for that. John has seen that many times where we go to the market, or John will take a company to the market with expectation that the buyer will pay for the rep and warranty insurance and provide a walkaway deal. So once we get to the closing table and the wires hit, unless there's some huge fraud, then the seller is going to keep every dime. And if there's an issue, like something we told the buyer as a seller was wrong, the buyer's recourse is to go make a claim against the insurance company, not the seller. So, it's super important to get as much of those protective provisions. I've got a checklist about 20 or 30 items long of issues that I'll make sure are negotiated at the letter of intent stage. And it pains me when I have a client hire me and they've already signed the letter of intent because it's too late to go get all that in there. And we're now hamstrung. And, there's a kind of a good faith idea that once you've signed a letter of intent, you need to stand behind those terms. And the more protective provisions I can get in there on the front end, the smoother and quicker your deal is going to be, and probably the more money that the seller is going to take home.
Yeah, thank you.
I agree 100%. I've heard naive sellers say, well, it's a non-binding letter, this letter of intent.
Right.
Therefore, we'll go ahead and sign it and get started, and we'll see how we negotiate it from there on. But Phil's right. I mean, think about it from the buyer's perspective. Now that seller is the guy who's retrading. right? So imagine the psychological effect you're having on the bidder. They may literally walk away in a scenario where you're suddenly asking for something that isn't in the letter of intent and wasn't what that buyer intended. So it's a way to really get off on the wrong foot if you're not taking that LOI seriously as it relates to what's in there. And another really important point of Phil's is you also have to make sure everything you care about is in there. But the LOI ought to be attractive to both sides, meaning you spend time figuring this out up front. It materially keeps due diligence fees down for both sides if you hammer out some of the most important items in that LOI. That way you don't go through a full QOB necessarily. You're not paying retainers, and you're not paying, all the other third-party advisors, post LOI that you often would. Better to get that hashed out early in the LOI.
Good. And you used a term, John, retrading. Touch on what that means, please.
Well, when we all agree that the price is $10 and then the seller decides that it needs to be 14. I mean, that's the most obvious one, but a lot of it comes around the terms and conditions, or someone says, "Oh no, I'm planning to go off to my lake home, and I'm not going to work here anymore," even though the LOI says that they're expecting you to stay on board for 2 years. There can be a lot of qualitative things like that that become really important, but retrading merely means agreeing to one thing and then saying it's going to be different later.
Okay. Reneging. And let's talk about what buyers want. The buyer wants the management. Most buyers want the management team to stay in place. They want a turnkey operation. So they buy the company. They want everything to continue. And then they're going to add capital. Maybe they're going to add their own, management team, their own expertise to try to grow that and get to the next level, increase revenue, EBITDA. If you as an owner don't want to continue on for a few years after a sale, you need to early on remove yourself and hire quality executives that can run the company, and you just act as an absentee or a overseer without the need to be there day to day. So I see it over and over again where people have basically created a job or handcuffs for themselves, and they want to sell, but they also want to leave. But if they're so integral to all the customer relationships and the vendor relationships and everything else that's critical, that's super hard for that person to sell and be able to exit. So that, I know, Armando, you see that quite a bit with your clients. I see that more often than I'd like to. There's ways and consultants that will help you remove yourself. There's Michael Gerber, the myth of the entrepreneur, that he's kind of the OG when it comes to how to remove yourself from your business and push down kind of the responsibility. So there's ways to get there.
Yep, thank you for that, Phil. And I want to go back to what you said a moment ago when we talked about LOI. I want to make sure that the listener understood what you said. What you said is, in paraphrasing, don't sign an LOI till your lawyer looks at it and reviews it and make sure that he or she's built in protections for you, the seller, right?
Correct. And a lawyer who knows how to negotiate LOIs, not just any lawyer.
Right. And that's a good point as well, that as you mentioned, the attorney that might have been part of the picture for the last 20 years when you started on day when you didn't have two nickels drugged together, didn't have 100 employees, that might not be the right lawyer. Well, that would not be the right lawyer unless he or she has that, especially as you said, in M&A being mergers and acquisitions, correct?
Right. Yeah. Right.
Yeah, exactly. People who do deals. You also mentioned, Phil, that what the buyer really wants to buy is a turnkey operation. So if the owner is integral to the daily operations of the business, it's harder for him or her to sell when they're so entwined in the daily operations. But having people in place for them who run it for them, then that's a much easier sell and probably leads to higher value.
That's right. Correct.
Okay, so let me ask another question, John, to you. What are some common surprises for that first-time seller as you're working with them?
Oh gosh. Well, we haven't talked about due diligence too much, but the burden of that, meaning the time spent as well as the level of scrutiny. Due diligence effectively means they're going in and seeking to prove out what we have stated is true, right? So all of those offering memo facts, they're going to go through. And I think buyers will ask for every contract, policy, invoice that you've ever touched. They're going to want to understand inventory, IP. Honestly, it is extremely time consuming, but I'll also argue to those would-be sellers that it's well worth your time economically, and done properly. What you would have us do at Columbia West, as well as Phil, your M&A attorney. So we try to do a lot of that up front, even before we start the process. Back to valuation and how do you drive up value. One of the most important things is making sure that you don't have a due diligence issue that actually erodes value later, because when they find it, they suddenly have less trust in your numbers, less trust in the way you operate, and they decide you're not really a 9 times deal, you're really closer to a 7 times deal. So removing those issues, because many of them can be fixed. Some of them are inherent in the business, but many of the others, such as a client contract that's unsigned, or sales use tax was a big issue I had one time, where my client had not paid sales use tax for out of state revenue. Things like that. I've had a client, we found fraud one time that the CFO was perpetrating during our preliminary work. So there are things that you can find in advance and fix, so that when you go through finally to that process and you're actually approaching investors, everything's been scrutinized and perfected. So it is time consuming. I think that's probably the number one surprise that sellers have found, just how much work it is. But I would also say you get paid quite well by the hour doing that, when you're talking about improving your valuation by 1 or 2 turns on a multiple. You already pointed out another thing is the emotional component. That's always very real. Even some of the most stoic of sellers that have sat down in our office that first meeting, we find later to be some of the most emotional when they realize they're not going to be in charge. Sometimes it's an identity thing. Sometimes it has to do with I'm afraid they're going to push me out, and I'm not going to have as much to do on a daily basis anymore. People look at it differently, but I've found that there's always some pensive behavior at some point during a transaction, because it is a big deal. You are not just getting a liquidity event, you're potentially changing your life. What else? I'd say often the feeling with sellers who've never done it before is that the deal's pretty much done once you've signed that LOI. Now it's just up to Phil to crank out a document over the next couple of weeks. It's really not like that. When you get into that confirmatory due diligence, there's a lot more work post LOI. So I'd say that's a misconception that I see a lot. I would argue there's at least 50% more work, or if not 75% of the work, that's still due post LOI. So I see that misunderstanding as well.
Wow. So then maybe John, just to follow up on that, the normal time frame for a sale, what does that typically last? Well, how many months do you get through a sale?
Well, I'll say I've closed deals as quickly as 45 days and as long as 14 months, which was uninterrupted, not including deals which have been put on hold. So it does vary a great deal. What I would suggest to you is for a deal that may go to a private equity group that tends to be a little faster. That could be 5 or 6 months going at a normal clip. And a strategic is typically going to be closer to 6 or 9 months. But don't be surprised if you have some issue that causes that to get knocked off. And usually it's something on the client side. We have a hiccup in our numbers and we want to get back to it, or maybe there's some due diligence issue that we have to get over. I would suggest it's always safer to plan on adding a couple months to those numbers, just in case. Don't put yourself in a situation where you're in a cash crunch because you think it's going to close sooner than it is. Plan on it taking longer.
Okay, thank you. And a question that we get is, how do we help an owner navigate exit? We're helping them to build that dream team. And as you said, Phil, the attorney, what you do as an M&A attorney, as a deal maker attorney, is a specialty within law. And what I found over the years is lawyers all specialize in something. an exit, selling a business is definitely a specialty. So what we're helping to do is build that team that they might not know they even need. So do they need that investment banker? Well, yes, and at least have a conversation with one before you decide to use one or not, so they really understand, John, how you can help them, and Phil, you as well, have that conversation so they can understand. I'm sure that people who are listening to this conversation today have heard a lot that for many is brand new information. And that's great. That's what we want them to understand more so they can make more informed decisions. But the way we're helping them navigate exit is to help them build that dream team after it's been determined that, yes, it is the right time for them to start walking down this path that they are actually ready to sell. Phil, a question for you. How does a seller walk away clean from a sale without having to worry or be concerned about what happens to the business afterwards?
Yeah, so that has a lot to do with what you agree to in the purchase and sale agreement. When you're selling a company, the negotiation and the stock purchase or asset purchase agreement is mainly about allocation of risk, like who's going to take the risk for something happening, or who's going to take the risk that something happened before closing that comes up after closing. And these days, for bigger deals, that you can offload that to a rep and warranty insurance company. Sometimes that's not available. There's some deals where it's too expensive, or it's an industry that's just not offered, or it's a small deal and it's not cost effective. In that case, we get into negotiating what are called baskets and caps or deductibles. That basically means that a buyer is buying a company. They're not buying the Holy Grail. They're buying an operating business. We know every business has warts. They're going to have to take some losses before they can turn around and make a claim to get some of the purchase price back. So the deductible is that amount, and usually it's a percentage of the purchase price. That's a negotiated amount. When you have rep and warranty insurance, that is usually 0.5%, 1/2 of 1%. For a non rep and warranty deal, it's higher. It can be 2%. It can be anywhere in between, above or below 2%. And then the cap is, if things go really bad, what's the maximum amount the buyer can claw back? And there's standards for those two for non-rep and warranty insured deal. It's all over the place, but there's categories of representations and warranties that you make in the purchase agreement. You tell the buyer about the company, your financials are according to GAAP. You don't have any employment lawsuits, stuff like that. Those are non-fundamental. Then they're fundamental reps, which are, we don't have any debt other than what we've told you about. We actually own the company we're selling you. So it's fundamental to the deal that if you're selling a company, you own it and you're able to sell it. You're not trying to sell someone else's company. So if that happened to not be the case, maybe there's a stockholder that you issued stock to and you forgot, and they come back later and say, hey, why didn't you pay me? That's fundamental. There's not going to be a deductible. You're going to have to pay back. Once the buyer fixes that issue, you're going to have to pay back every dollar to make the buyer whole. So those are, having a team that understands market, understands how those work, and negotiates that to make sure it's a fair deal and the seller's not taking excessive risk, I think is how that works out in most deals.
Yeah. And so you mentioned baskets and caps, Phil. It sounds like what that's doing is putting some guardrails.
Yep.
And limiting that risk on the low end and on the top end as well.
Yep, absolutely. And Armando, you'll appreciate this as an accountant. One of the most important steps that a business can take is to have solid reviewed financials, maybe even audited financials, and to have a good accounting team that will adopt accounting policies, review what's been done. Because if John gets a company that wants to go to market and they've got like a shoebox full of receipts and where books without having actual accounting policies and a good chart of accounts, it just puts everyone behind the 8 ball. It takes a lot longer. I had a deal where it was a cash basis taxpayer. They just basically expensed everything. They didn't accrue current liabilities. They didn't accrue receivables or anything else. And in every deal, you set a working capital target. That just means that when you sell the company, you need to deliver a certain amount of current assets, and the buyer takes a certain amount of current liabilities. So that's usually a net positive number. Not always, but most of the time it's positive. Well, the buyer proposed a target that did not accrue for any liabilities. They just based the target on all the current assets. So we fought, and and got them basically to allow us to accrue, even though none of the financials reported any accrual-based current liabilities. And that was a $300,000 difference.
Wow, that's substantial, substantial. Thank you.
Yeah.
John, a question for you. How can you structure a deal when you're trying to keep multiple owners happy? Maybe two partners, three owners of a company. How does that work?
Well, if you're figuring it out at the table in the moment, you've probably done something wrong, right? Alignment starts early, I would suggest. And the time to start that is now. And whether you're a seller in the next 6 months or next 5 years, you should start marching all in order, clarifying objectives with your team. So that's your owners. It's also your operating team, your managers, your CEO, head of sales, CFO. But it's obviously important exclusively to the sellers as well, the actual owners. And the issues can come around. I mean, obviously, how much liquidity, how much is cash versus equity or earnout or something like that. What kind of equity rollover are you going to contemplate or be willing to do? Your future roles. Are you trying to exit today personally as a manager, or would you like to stick around forever? So, and then exit timing is very relevant when you get those surprise offers. Are you all certain when you want to exit? It's okay for people to have different objectives, but it's important that if that's the case, then you need to structure something that I'll call it balances those. So, part of it relates to just what one wants to do, right? The operating discussion. But what I'll also say is the other side of the table may very well weigh in on some of these issues. So just to make up an example, say an 80-year-old founder may be allowed to fully liquidate today, whereas the 40-year-old CEO who is actually running the business is expected to roll some equity. Right. So you have the seller's goals, but you also have the buyer's goals who are trying to use structure as motivation to ensure the right incentives.
Yeah, so two things about that, John. Excuse me. You mentioned rolling, and explain what rolling means in the context of selling to a buyer.
Equity rollover means that if you sell a business for $10, you may actually receive $8 and then $2, all of this pre-tax, of course. Then the $2 is rolled into equity. That means you sit alongside the new buyer as an equity holder. So, contrary to what some people might think naturally, I actually have found many clients to do extremely well with that equity rollover. And if you think about it like this, you're a bootstrapped entrepreneur who founded this thing. Now you're at a place you've been running it for 15 years and you know how to grow it. It's to invest $5 million into this new machine or this new piece of equipment or new facility that could help you take this business to the next level. Where, 5 million feels like a lot to someone who might be 75 and nearing retirement. There are these moments of growth and inflection where that owner operator may not actually be as aggressive as a new buyer might be.
Right.
You might find a strategic or a private equity group who's might not just do one of those machines but two of them, and you might find that equity grows quite rapidly. I've certainly seen more than one client make more money on that equity roll than they did on their initial sale. So that certainly happened. In interest of full disclosure, I'll also say I've had a client lose 100% of their equity roll too. So you really do want to believe in that buyer, in their ability to grow a business. But hopefully you see something in them that you like. Otherwise, you may not have chosen them in the first place. So.
Right. So it sounds like some thoughtful consideration needs to be taken to determine should you roll some equity into the buyer's company or not, or how much. Yeah. Okay. Thank you, John. And a question that
Armando, one point on that, if you're going to do that, you're going to want to do what's called reverse due diligence. And that's where you due diligence the fund, the private equity fund, or the strategic buyer,
Right.
and look at their financials, look at other companies they've acquired and how they've treated their people, and make sure that someone you know would want to own equity in.
Right.
Ideally, those line up. You sell to a good company, you sell to someone that's going to treat your team right, and that's going to also acquire additional companies and grow. There, you know, I've had clients sell to a PE fund as a platform acquisition. That just means the fund stood up, they've raised their capital, and now they're acquiring companies. And my client was the first one, and that's done at a certain multiple, say 7. And then they add additional companies at 7 multiple, 5 multiple, 6 multiple. As the EBITDA goes up, the value of the platform of the entire PE private equity fund goes up, because higher EBITDA companies sell at a higher multiple. So if the financials didn't change at all, if you sold at a 6 multiple and the EBITDA grows up, so now it's trading at a 12 multiple, you've doubled the value without changing anything else. And the PE, guys and gals will tell you they're going to increase revenue, they're going to reduce expenses. So everything goes up and to the right. And that's where you can have a second exit where you roll 20%. It could be bigger than your initial sale.
Yeah. Thank you for that, Phil. And I do want to just clarify a point on that. What you're saying is that when that, say, private equity firm buys one little company and just holds one company, that company valuation is at a certain multiple. But as that footprint gets larger, as that private equity firm now has many companies that's rolled up, it's not just worth more because it's a bigger company with more sales than that. Its multiple that determines its value is a bigger number. Right?
Correct.
Okay. Good. Thank you. Looking at time here. So a question that we hear is, how do we help folks after they sell? What we're doing is helping them map out their future that they're going to have. What is that cash flow going to be for them going forward? And we need to make sure that we can map it out so month by month they understand what their cash flow is going to be net of taxes going forward, so they can understand what that lifestyle can be that they're trying to maintain going forward, and what they can leave for legacy for the kids, and what they can do in terms of an impact in the community that they might want to have. So we're helping them to oversee all the financial matters that matter, helping them to issue spot, to head off things that might be coming up down the road, and making sure that everything stays on track with that one overarching strategy for the rest of their lives and beyond. I'm going to go through a couple of quick questions here. John, a question for you. You work with institutional buyers. What does that mean to the seller, to our audience?
Yes, 100% of what we're doing commonly sits across the table from institutional buyers. So just quickly put, that means private equity funds, family offices, or strategics. And that commonly means businesses who are larger. They do this for a living. They tend to be sophisticated, data-driven, and they often have very specific return hurdles and investment criteria. So if you're a business that falls within their lens, they're very excited about it, but they can fall away very quickly if they're not. So they tend to be a little more decisive than individuals. They tend to bring professional management, growth capital in that example, for example, that I mentioned earlier. They tend to be anxious for growth relative to aged entrepreneurs, and they'll also often structurally provide that second bite of the apple, we call it, that equity rollover opportunity through retained equity. So their process is typically rigorous, and there's that joke, they buy businesses every day, and you're only selling a business once. So with institutional investors, you certainly want to make sure that you're protected with a good banker and an M&A attorney and CPA to make sure that you're doing it properly and watching yourself. I don't mean to say that they're more spurious or ill-intended than others, but you certainly have an opportunity to be taken advantage of if you're not careful.
Right. It sounds almost like a David and Goliath story. They've
Very
done
much
this
so.
over and over and over again.
Very much so.
If you're out there, the seller all by yourself, without a John Farr or without a Phil Guttilla, or without us to help with that navigation going forward, they could put clauses in that benefit them in the LOI, clauses in the sales agreement that benefit them, and it could leave our audience member who's listening really in a really bad spot.
Yeah.
Yeah. Okay. And obviously we don't want to see that, of course. Um, a couple of quick questions, and then we're going to need to wrap up here and open it for Q&A. Phil, reps and warranties, you've talked about that. Anything about reps and warranties that maybe you can add so that the listener can understand more of what that really is?
Yeah, so it's going to be about 20 plus pages of your purchase and sale agreement where basically the buyer's asking you to make representations about the company and basically tell them what's true. You can always have an exception. So if a provision says there have been no employment lawsuits in the last 5 years, but you did get sued by an ex-employee that settled or whatever, we would just say, except it's set forth on the schedule, and you disclose that, and then the representation is true. What can happen is if you don't disclose it and that later comes up and it causes a loss to the buyer, that creates a claim for them where they can go back and make a claim against you, against the seller, and recover some of the purchase price. So a lot of time and effort is spent by your legal team going through the reps and warranties with the seller, making sure that they're accurate, making sure that any exceptions or carve-outs are put on a disclosure schedule. That way, when you get to the closing table, you're comfortable that what you're telling the buyer about the company is accurate and that it's unlikely that anything is going to come up that hasn't been disclosed or the buyer doesn't know about. So it's part of the risk allocation. It's part of the getting into the weeds that really isn't all that exciting, but it's part of the process. The length and diligence that the buyer is going to go through will go into the reps and warranties, meaning they're going to ask about all that stuff through a due diligence request list. Then they're going to ask you to back up you have disclosed to them what they found in the purchase agreement. I like to have clients of mine that come to me ahead of time, like 6 months or a year, go through a sell side diligence process. Basically, I'll run them through that process over a 3 or 4 month period that a buyer is going to take them through. And we do a legal diligence review without a deal on the table when we can take a project management approach, set, a couple pages we cover in a week, we wait a week or two and then cover the more and more, and then we build out a data room. Part of that process and part of the benefit is you identify a bunch of gaps. Almost always there's a gap. We don't have a restrictive covenant with a key employee. We got some software developed and we need to make sure we have that assigned. There's a trademark that's owned by an individual owner and not the company itself. All that stuff can get fixed as part of that process.
Okay, thank you. A question that we get is, once, as you said, there's $100 million, $200 million in cash now that the business is gone. But the question we get is, well, how do we invest those monies? Now that I've got this big pile of money, how do we invest it? And it really depends on what that family situation is. So if the couple is a 50-year-old couple versus a 70-year-old couple, we're going to invest those differently, really because of life expectancy. And maybe if they each want to get, $30,000 net a month of cash flow, it will be invested differently based on their risk, based on life expectancy, and based on what they're trying to accomplish. But each of those portfolios each is a custom portfolio, customized to what that situation is in that family and what they're trying to get to. And one of the tenets that we use in that is we want to get them what they're trying to get to, help them achieve their goals while taking on as little risk as possible. So let's not swing for the fences. Let's instead get them where they want to be with minimal risk in getting there. So there are studies after studies after studies that will show that the types of retirees who are the happiest have a steady paycheck, a steady income in retirement. So that's what we want to build out for them. Now that the company is gone, how do they then replace that paycheck they've gotten for their company, replace it now with income coming from their stocks, their bonds, maybe their rental income, maybe they've got some annuities, whatever the source is, but we can get them some recurring income on a steady, regular basis to get them that comfort that puts them in that happiest retiree category versus not. All right, a couple of quick questions here for you, and we're probably going to need to wrap this up. Let me instead go to Phil, a question for you. Last 30 seconds. What advice would you give to that first-time seller who's listening to us right now today? What advice would you give them?
Well, just taking steps to prepare for a sale. So, every company is eventually going to sell. It's either going to transition to employees, it's going to be sold to a buyer, something's going to happen. So I recommend that business owners take steps to set it up so that it can be easily transitioned, adopt systems, get your legal house in order, just, get the process going. Talk to someone like you, Armando, talk to me, talk to John. We can make introductions if you have gaps in your team, if you need a good accountant to put together a, accounting policy and start doing gap financials or reviewed financials, we can help you with that, get you connected to the right people. So it's getting the team together, and then you have us ready when you decide you want to go to market. And the companies that I see, I do deals on both sides. When I get a seller coming to me and I'm representing a buyer, a PE fund or a strategic buyer, and just to be clear, a strategic buyer means a company in the industry that's buying other companies, either vertical or horizontal integrated companies. When I get a seller who's done all this work, who's done their diligence, who opens a data room, who everything is organized, that's the kind of deal where there is no retrade on the price. They're going to get the maximum price when you've done that. So that's part of the goal, is to get as much as possible, keep as much as possible, pay as little in taxes as possible. And all that needs to be planned out, ideally well ahead of going to market.
Perfect. Thank you. John, same question. 30 seconds. What advice would you give to that listener who's going to sell his or her company for the first time?
It's practically the same answer. You do not need to wait until you're tired or ready to exit to start preparing, right? You can build that data room. You can clean up financials, contracts, understand what your normalized EBITDA is, meaning with adjustments, start tracking those. Particularly estate planning and tax planning. There are things that you can do now to minimize taxes later when you sell. You literally have to do those now instead of on the eve of sale. Sometimes there are certain strategies that you cannot implement that late. So just because you're preparing doesn't mean you have to say mentally and emotionally, I'm ready to sell right now. You don't have to yet, but you want to be prepared to do that. We call it dressing up your asset every day. You only sell your business once. So, you really want to optimize that. And then what I'd say is, I'll dovetail on what you were saying, Armando. Then you really want to put your money someplace safe. Let's be honest, if you're an entrepreneur, you've had moments of stress, if not a lot of stress, for your entire career.
Right.
Put it in something safe, diversified now, de-risk your life. I imagine it'll change your perspective. You'll have a little bit more fun, and you've certainly earned it.
Right. Thank you. In the last 30 seconds, I would say, what advice would I give to the first-time seller? Yes, what you've said, start well in advance, of course, build that dream team. But I'd also start with, are you ready? What are you really trying to get to? Are you mentally ready for it? Are you financially ready for it? Are you emotionally ready to begin to walk down that path of selling your company? Because there are no do-overs. You've got one chance to take this company you've built over the last X number of years. You've got one chance to transition that to a new owner, and it's got to be done right because your family depends on it. So thank you, John and Phil. Let me just wrap up here because as you can see, we could clearly go for another half an hour if we wanted to, because there's a whole bunch in this topic. And for the listener, if you've liked what you've heard, we have a podcast where I've had a full hour conversation with John Farr and also a separate conversation with Phil Guttilla. So if you like what you've heard from them and want to hear more, happy to give you those links to each of their conversations. You'll learn more from those conversations as I did, as I spoke with them those events. And we're going to have another event like this on January 29th, Thursday, January 29th. This is going to be at Venture Cafe in Phoenix. So again, if this topic is relevant to where you are right now with your business, then you might want to jot that down. Thursday, January 29th. That will be the next event, this same topic coming up. And now I'll ask you just to take a deep breath here, because you've had a whole boatload of information that maybe is a lot of information for many of you. But I'll ask you just for a moment just to imagine. Imagine it's the day after you sold your company. You're feeling great. You've got no payroll, no budgeting, no cash flow issues, no customer complaints, no more employees. You've got none of that. And you're waking up, coffee smells great, the birds are chirping, it's a beautiful sunny day outside, and you just feel fantastic. And you feel that way because you implemented the thoughts and ideas and concepts that you heard here today. That is what's possible for you. So, John, I want to thank you for contributing your expertise to this conversation. Extremely, extremely insightful. Phil, you as well, extremely insightful information. And let's see if there are questions that we might have here. It looks like I see a question here. And the question is, in your experience, how does the seller, quote, take care of, unquote, key non-owner employees who they'd like to reward? Do owners bonus these employees with funds from the sale? Do they negotiate favorable terms for their continued employment? Phil, I'll ask you if you have thoughts on that, or John.
Yeah, I'll start. I'm sure John has some ideas. So I think all of the above. Usually with key employees, they get a transaction bonus. That should be tax efficient for the seller, meaning it should be an ordinary deduction that flows through to the business owners. I like to negotiate in the letter of intent certain terms that the buyer is going to keep the employees at or above their current comp. They're going to keep the benefits in place for a year or 2 years. I mean, usually you can't get 2 years, but at least a year, 18 months after closing. You also can require the buyer, disclose what kind of management incentive plan, MIP, are they going to put in place? How are you going to keep these people tied in and make sure that you are happy with those terms and you know your employees better than the buyer? Is that something that's going to resonate? So it's those kind of things that you can do, including equity, potentially giving actual equity in the buyer that invests over time. That's done too.
Thank you, John. Any thoughts, additions?
No, I agree. All of the above. And the inputs are, is it a strategic buyer or a private equity buyer? And who are we taking care of? Is by personality, is that person an aggressive grower of a business who may not do well in a staid, $100 billion strategic that doesn't move very quickly? That person may have opinions. So if that person helped you get an outsized sale, maybe you literally just bonus them some of that. And in another scenario with an aggressive grower private equity group that your employee is excited to be a part of, maybe you push to negotiate some equity for that person. So it really does depend, but the answer is absolutely all of the above. And I think it's important, by the way, to communicate that you are going to take care of them before you go down this road of the process. Make it clear so that they are excited to do this. It's easy to take care of them when they helped you grow enterprise value from $10 to $15 during a sale. It helps to have a little bit more room there to take care of everyone.
Yeah, but you don't want to lose those key people when they are part of the enterprise value that the buyer is buying. So you want to keep them around, of course. We got another question here about signing a non-disclosure agreement, an LOI. The question is, let's say that the prospective seller receives an LOI and it sounds pretty good. They're pretty excited about it, but then they don't know what to do. We've touched on this. Phil, what should they do?
Well, that's kind of an inflection point. If they have not talked to an investment banker like John before that, that's the time to talk to a banker, talk to an M&A lawyer, because what they definitely shouldn't do is sign it and send it back. They need to have professionals on their team. Armando, you, of course, talk to you about, what your view is. You've got a financial, background, and you can give them your thoughts on the pricing, the value, that stuff like that. So, John, can run a process. You get an LOI, like having one buyer is like having no buyers, because they've got all the leverage if they know that you don't have bidders lined up behind them. If you've done at least, you don't even have to do a full process. You've gone out and tested the market and you have people interested. Just having that in your back pocket puts you as a seller in a much stronger position. It will permeate your attitude through the deal. If you can just walk away and go to someone else, it's going to allow us as your team to help keep the buyer, to their word.
Yeah, that last strategy Phil just mentioned is pretty critical. We've done that a few times where we did just a quick go out to market. We didn't spend a ton of time perfecting the sim. We went out to the most likely bidders, keeping that one first bidder warm, but going out to the market in a manner of keeping them honest. And you can do that. You can play favorites in a process, but you want to make sure. And it's funny, in some of those processes, we do wind up selling to that single bidder. We did one in one case where we sold it to the same bidder, but they paid 28% more.
Oh,
Um, there have been other times where we realized that first bidder was grossly undervaluing the target, and we wound up selling to someone else. So you don't have to accept that. And one thing I'll say, they say if you don't accept this offer, we're walking away. They're not walking away. They're in the business of buying this business. They don't put out offers lightly.
yeah.
Don't buy into that negotiating tactic. We'll make sure that they don't walk away, and we'll make sure that you're optimizing your sale.
Yeah. Another question about under what circumstances should the business maybe need to do some restructuring in anticipation of a sale? And Phil, we recently talked about this code section 1202, which can be extremely impactful for a C corporation that's going to sell. That's one thing that's very specific, that can be pretty impactful. But in terms of restructuring, Phil, what thoughts come to mind for you?
So a lot of small businesses are operated as subchapter S corporations. Almost every time we have an S corporation seller, we need to restructure it to put a holding company above it and make that entity a subsidiary disregarded entity that gets sold. That's for tax reasons. It's for most buyers are not going to want to take the subchapter S risk and buy your stock and make an election to be taxed as an asset purchase. So we do some restructuring where that risk stays behind and the buyer can buy a company, get a step up in basis because they get asset purchase treatment, which benefits them. We can obtain a gross up, so it's still effectively all long-term capital gain to a seller. That's a common deal term we negotiate in the letter of intent. If we don't ask for it at the LOI, it's really hard to get it later, but at the LOI stage, we can say, we'll structure this so you get asset purchase treatment, but you're going to pay a gross up to the extent we have to pay a higher tax rate. And that long-term capital gain rate, is 20% federally, plus you got the, Medicare surcharge. So it ends up being around, 23% or so
Okay.
versus 37.
Okay. Yeah, substantial difference. Yep. Thank you. Another question about taxes. You mentioned, Phil, earlier about trusts, maybe charitable trusts as well. In terms of taxes and mitigating taxes going into a sale, can you touch on some of the strategies that can be very impactful to help reduce taxes on that sale?
Yeah, so let's say someone's got a philanthropic bent and they want to benefit a public charity, a charity, or set up their own foundation, a family foundation. You can have a nonprofit entity that's tax exempt, that your family's on the board, and you have money in there that you then give scholarships out or help the needy or whoever. If you transfer part of your ownership of the company ahead of time into that, it could be even a donor advised fund, and then that entity receives the proceeds. Not only do you get a deduction for that gift, you have to get it valued. We have to hire a valuation expert to tell us what that deduction is worth. But then when it sells, you're not paying tax on the 10%. So it's like a double benefit. You can't do that right before closing. You have to do it before a deal's on the table, before a contract is signed, ideally before you have an LOI. But if you have a non-binding LOI, we can still do it. But there needs to be some time between when it's funded, when you make the gift to the charity, and when you actually close the deal or sign a binding transaction.
Yeah.
So that's super important.
The thing Phil is talking about is one of the number one reasons why you start early, right? Some of that stuff you just can't do on the eve of a sale, and it's big dollars potentially.
Right. Yeah. Thank you. We were talking with the client just very recently about their own family private foundation versus a donor advised fund. And it was a quick conversation because it was very clear that once the business sold, he said, I don't want a part-time job. I don't want to have a private foundation. I want to manage it. I want to have employees. I want none of that. They want to give and they're charitable, yes. So for them, a donor advised fund is such a nice, cleaner, simpler, faster way to get to the same place. And as you mentioned, Phil, giving some of that company away, some of the equity to the 501c3 charity before the sale, like you said, it's a double bang for the same buck. Extremely, extremely impactful. So let me see if we have any other questions here. Nope, that's it for questions. And I think that we are good. So Phil, thank you so much for your time and expertise. Really, really appreciate that. John, appreciate your expertise as well. And I think the dialogue was extremely helpful for those people who are on this conversation with us, listening and thinking about their own exit down the road. And whether you're thinking of exit in 5 years or in 10 years, I think you've got the message pretty clearly. You want to start early. You want to have a conversation early. And I'd invite you to have a conversation with me or with John or with Phil. And the sooner you get going on those conversations, the better. As I mentioned, we will follow up with each of you afterwards to share with you our white paper from our prior Scottsdale Founders Forum events, where we've had over 200 founders come to our events. On that one-page white paper are the top questions that founders had, the top expert recommendations from, say, John and from Phil, and the pro tips they gave that can help people to have a more successful exit for themselves and their family. So again, thank you, appreciate it. And this concludes our Fall 2025 Scottsdale Founders Forum event.
Thanks, Armando.
Thanks, Armando. Thanks, John.
I know.
Bye-bye.